In this video, I'm going to reveal the 4 most popular strategies that bank traders use, and most importantly, how you, as a retail trader, can apply them from the comfort of your own home wearing pajamas like me. Hi everyone, I'm Lien. I started my career as a bank trader at JP Morgan, where at just 18 years old, I was their youngest hire ever. Now, my first job was actually on the Forex trading desk, making markets in the euro, the Japanese yen, and other major currencies. When JP Morgan merged with Chase, I moved from Wall Street up to their Park Avenue, Midtown location, and onto their prop trading desk. That experience, along with my time working with hedge funds, gave me deep insight into how institutional traders make money. And today, I'm going to share those insights with you and talk about how you, as a pajama trader, can trade that way too. Before we dive in though, make sure you subscribe to the channel and hit the notification bell so you never miss valuable trading tips. Bank traders have plenty of ways to make money, but from my experience, from what I've seen, these are the 4 most commonly used strategies. Now, you may have heard of some of them, and some of them you may have never heard of, but don't worry, I'll break them down for you. Number 1, bank traders like to trade the flow. Number 2, they trade events. Number 3, they trade arbitrage, mean reversion. And number 4, they trade global macro. Don't worry, I'm going to explain these. What does each of these mean? Now, let's start with trading the flow. Trading the flow means riding the move in the markets. Now, I want you to understand something. The Forex market is a completely unregulated, decentralized market on the bank level, especially for these big players. There isn't one regulatory body that kind of governs them all, and there's certainly no exchange like the New York Stock Exchange or the CME to track orders. Instead, the customers are banks, and we're talking about the big customers like hedge funds, institutional traders, multinational corporations. They call into the bank, reach their salesperson they play golf with, and ask them for a current quote of euro-dollar, for example. Now, the salesperson who sits on the trading desk, most likely across from the dealers, will stand up and ask for a euro-dollar quote for, let's say, 50 million euros. Now, the dealer will give the salesperson a quote based on where he or she thinks they will be able to get out of that $50 million, how they can get out and offset the position in the market. And the customer will either make a deal, either sell euros or buy euros, or call back because they're just checking rates. Now, if they do deal, or even if they decide to pass, sometimes the dealers already know which way they are leaning. And they, along with the prop trading desk, who, at the time when I was there, was not sitting very far away from the market making desk, will jump in and join the move because 50 million euros will move the euro-dollar pair. And this is what I call riding the flow. Now, we as pajama traders don't have access to client flow, but in reality, trading the flow is the same as trading momentum. You want to be on the side of the market, riding the movements of the day. And in fact, that's exactly what I do every single day. And that's the same philosophy I trade today that I learned 20 years ago. I trade the early New York and Asia Open because that's when new bank traders are coming onto their desks. They're looking at the news flow. They're looking at the price action, seeing if significant levels have been broken, how things have changed in the prior session. And usually, they're adding to the move. They're joining the move. What I like to do is jump in as well for continuation. Now, I personally use my zip trading strategy to do this, but every day. But a simple way for you to ride the move is to run for the round numbers. I mean, there's a lot of ways to do this, but one way is to run for the round numbers. If euro-dollar or pound-dollar is close enough to the 50 or 100 mark, meaning 20 pips or so during the most active hours, which is a London-New York overlap between 7 a.m. and 12 p.m. New York time, they tend to push for a test of that level. I want to take an example with you. So right now we are looking at a euro-dollar chart together. So what I'm going to do is I'm going to mark some of the key levels, like for example, 104, 103.50, and let's go ahead and mark 103. So these are the round numbers, which is 00, 104.00, and 103.00, and then the 50 marks at 103.50. So remember, I said that if it's close enough between the 7 a.m. to 12 p.m. New York time mark, usually it would like to run for that level, especially if it hasn't tested that level before. So, you can see right here, in the euro dollar during the session, it's rallying. and we go from, basically 20 pips or 25 pips before that level. We get close enough. We hadn't been at 104 for a while, and it makes a run through it right at around the London close. Here's another example. This is right at the New York data. When New York data is released, we get a push lower. And this is really, really nice, which is when it's off of a piece of data. When it's off of a piece of data, the momentum is fast, and oftentimes it will quickly breach the round number. And this was the US inflation report. Eurodollar selling off, broke through, was close enough to 103.50, broke through that level, and then went some more. Here's another example here. During the New York Open, we're rallying. We're at 103.20, 103.30, 103.40. So pretty much when it gets to 30, and we're at during the active market hours, around 10:30 a.m., you can see that it makes a run for the round number. This is a characteristic or behavior that is very typical of Eurodollar and pound dollar. These currencies, and even dollar CAD, they love to run for the round numbers. So this is an example of riding the flow. If you know that the flow is generally to test these round numbers or the 50 levels, you can join the move on the anticipation that more often than not, these levels, if it's during the active market hours and there's no big event risk ahead of us, will be tested. Of course, nothing works 100% of the time, but it's enough that I also will use those probabilities and use the odds of it running for the round number in my trading as well, and buy if there's a zip signal and we're close to a round number. The second common bank trading strategy is event-driven. This is an easy one for pajama traders to replicate. Banks may take a trade ahead of a big upcoming release of the US jobs report because they think it'll be strong or weak, or they may jump in after the US jobs report because it was strong or weak. As retail pajama traders, we know not to front run a big report like that because most of us aren't smart enough to predict its outcome. Instead, the brighter thing to do, the savvier thing to do is just wait. Wait for the number to be released, wait to see how the market responds, and ride the move that follows. Ride the event that after it's released. Here's the latest example in Eurodollar. You're looking at a 5-minute chart, and we've got crazy whipsaw non-farm payrolls candle right here. The data was mixed. We had slower month-to-month job growth, but wages were stronger and the unemployment rate declined. Most people won't really know what to make of this because one piece of the puzzle was weak, another one was strong. So instead, you wait. You wait to see what the smarter traders are doing. And, in many ways, the smartest traders are the patient ones. The best strategy is to wait for either the high or the low of the news candle to break. As you can see in the chart, the low of the news candle breaks about 2.5 hours later, which is a pretty long time, right? Still, this patience proved to be the right move because selling that move led to a 40-pip continuation with very little tracement that also happened relatively quickly. The third bank trading strategy is the mean reversion arbitrage strategy. Fancy, complicated words to describe things that are just basically out of whack. When bank traders see things that are out of whack, they take a trade on the premise that things will return back to normal, get back to the average. As pajama traders, we don't know sophisticated math. We don't have access to complex, high-frequency algorithms. So what can we actually do? Well, we can assume that on a short-term basis, when prices get overextended, they'll return to average. One way that I like to do that is with the use of Bollinger Bands, which are kind of like rubber bands. Let's take a look at the chart. So Bollinger Bands are basically like rubber bands, and they measure overbought, oversold conditions. So when the price gets really overstretched and the rubber band gets really overstretched, and you can see that the currency pair basically touches the bands, that means that the currency pair is either overbought or oversold, and that it will probably snap back like an rubber band that gets pulled out too far. It'll snap back and come back to the middle, to the norm, to the average. So let me explain what this looks like on the charts. And, we use here 2 sets of Bollinger Bands. The reason for that is because sometimes when the currency pair move is strong and it's falling, it may be for a very good reason. Or if it's rallying, it may be for a very good reason. So we don't want to just jump in and arbitrarily pick a top or bottom. What you want to do instead is to wait for the move to basically take place before you get into the trade. So this is what we're looking at. So I'm going to go to my charts. So right now you're looking at the Bollinger Bands. I've got 2 sets of Bollinger Bands here. The outside Bollinger Bands are the 3 standard deviation Bollinger Bands. The inner lines are the 2 standard deviation Bollinger Bands, which is typically what you get when you add Bollinger Bands in your charts. And this is the basis. So, how do we as pajama traders kind of replicate this arbitrage, mean reversion, getting back to the norm, things being out of whack strategy? So one thing that I like to do is I like to wait to see the euro dollar close below the 3rd standard deviation Bollinger Band, meaning that things have gotten so out of whack that's 3 standard deviations away from average. So euro dollar closes past the 3rd standard deviation Bollinger Band. But just because it does that doesn't mean that it's time to trade, because it could be doing it for some reason. Maybe the German economy collapsed, or maybe, I can't even imagine what kind of disaster, but let's say that it's happening for a very good reason. So you want to make sure there's a little bit of stability before you get in. And it's very important to mention that we're looking at this on 15-minute charts. You see your dollar close below past the 3rd standard deviation Bollinger Band. And then we wait. We wait for it to rally, and we wait for it to close back above the 2nd standard deviation Bollinger Band, meaning that we're finally seeing a little bit of a bottom form. And so we want to pick the bottom, but we want to wait for the bottom to prove itself that's forming first. So we finally get a close above the 2nd standard deviation Bollinger Band. That's the buy signal. And when you get the buy signal, you can target the average, the 20-period moving average, or you can target the Bollinger Band on the other side. Both of them are very effective exit strategies. So that's one example. Let's look at another example. Sometimes we get a very big move like that. Sometimes, and usually a 30 pip stop is sufficient. 20-30 pip stop. Here, we get a close past the 3rd standard deviation Bollinger Band, which is past the outside line. You wait for it to close below the 2nd standard deviation Bollinger Band. It does go up against us, but it's really not that much, because you would enter at 103.71. The high of this is 103.85. So it definitely would not have hit your stop. So you sell there. And depending upon the risk reward, you probably would have, because this is very close to your entry, you probably would have closed your trade down here. So that's another example of the Bollinger Band strategy. Here's another example. This is not so perfect because we didn't really close past it, but if you traded that, that would have worked as well. And, here's another example over here where we close past the outside line. You wait for it to close back below the inside line. You trade this and then either get out. You probably end up getting out somewhere over here. And here, this is a gap example, but still an example. Here, it gaps past the 3rd standard deviation Bollinger Band, closes above it, and then you target the inner line or you target the Bollinger Band the other side. So I think I showed you maybe 5 examples. At least 4 of which were winners. Those are the type of odds that I like. No strategy will win all the time, but you want a strategy that wins more than it loses. And this is a way that you can replicate or copy what bank traders are doing using some of your technicals. Now, if you want me to explain the strategy in more detail, I'll be happy to do a full dedicated video on the strategy. Just let me know in the comments below. Type something like, I want the strategy video, and I will be more than happy to do a dedicated video on this. Lastly, some of the biggest hedge funds and bank traders trade something called global macro. What in the world is global macro? It's basically a fancy word for the big stories. We're talking about things like tariffs, trade wars, recessions, pandemics. Bank traders will take these long-term positions based on how they think these stories will affect the economies and the markets. As pajama traders, we can and we should basically do the same. These are stories that create our longer-term fundamental views, our fundamental bias. Now, it may be hard for you to learn where to start, but every Monday in our live stream, we talk about the big stories, the fundamental outlook for the major economies, and the opportunities that can come from them. If you subscribe to the channel, you'll be notified of all these events, so you won't be able to miss any of them. That's a good way to start. Now, I hope you found this video valuable. If you did, please hit the like button. That keeps me motivated. And let me know in the comments below if you want more on that Bollinger Band strategy. Otherwise, I'll see you all in the next video.